Good afternoon and welcome to our very bad, terrible, horrible VC secondary podcast with our amazing and exciting guest, Kelly Rodriques, CEO of Forge Global, which is now part of Schwab. And Kelly, welcome to the program.
Happy to be here, Dave.
I was wondering if we could start out with a little bit about your background and kind of how you got into venture capital and secondary, maybe a little bit of the journey running Forge, both before and after you guys became public.
Yeah, sure. Look, like everybody else, I was drawn to the Bay Area and I got involved in startup-y businesses after working in big corporate for a little while. Was a founder, sold my first company really out of public registration. We were going public in the late 90s, early 2000s when that big
Another
dot-com
exciting
crash
time.
happened. And I just kept doing it. Either companies I started or companies that other people started and venture capitalists brought me in. I had a little 3 or 4 year run as a venture capitalist myself, but
Okay.
4 different exits. And the through line is really technology infrastructure to scale businesses.
What did you see in that time frame? That was pretty volatile time frame, late 90s and into the early 2000s when it was the other side of volatile.
I mean, I think the big shift that I saw probably in the middle of my career around 2010 was a lot more money was coming into the venture space. And
Yeah,
it was pushing out the time frame that the previous era had required for a company to go public, get successful or not. And so
right.
you went from having like a 5 or 6 year window in the late 90s to mid up to 2010. And then it just seemed like the funds started getting really big and the amount of capital accessible to private companies began to grow to the point where an IPO wasn't necessary in year 5 or 6. You could push it out. So
Right.
now here we
Or
are at year,
possibly ever in some
or
cases.
possibly ever, or possibly ever.
Right.
That's a discussion that's happening in these walls all the time.
So I guess if we look at the late 90s as like anything could go public, at any or no revenue. And then maybe the early 2000s was, okay, you can go public with 50 to 100 million in revenue. And then fast forward to today, well, it feels like you need half a billion to maybe, a full billion or more to go public. And I guess, that's probably because venture capitalists are greedy for keeping those companies private. But we've really pushed out the time frame from, 5 to 7 years, maybe 10 years to now, I guess 12 to 15 years in some cases for companies to go public. Is that your view on what the time frame is these days?
I think I would say probably 15 years, although SpaceX is 24 years old. And it's funny.
Yeah,
I
right.
think this has less to do with the VCs and actually more to do with the operators themselves. Because if I think about it, as a CEO myself, I wanted to keep doing it as long as I could. The venture capital timeframes for liquidity, as most people know, that most of these funds are 10-year funds. So you think about a
Right.
company on average being 15 years when it goes public.
That doesn't work.
You're now running past the VC timeframe. So they've got a liquidity problem as bad as the employees do.
Yeah, I think my first two funds that I managed at 500, at least for the first 8 to 10 years, are now 16 and 14 years old. And
Right.
fortunately, they're both at 3x net DPI, but there's still, some upside that hasn't happened for a few of those companies. So it certainly feels like the majority of the value coming back from VC funds doesn't really happen until at least, 10 to 12 years in. You're sort of lucky if those funds get to 1x, by 8 to 10 years, but a lot of them don't really start returning the big winners until after 10 to 12 years. So I was having this conversation with people the other day where the market used to be sort of before companies go public, that's the venture capital world. And after they go public, that's the retail world. But now there's kind of this middle ground that might be, companies doing 50, 100 million revenue and up. And it might be 5 years or more before they go public. And it's kind of like this middle world. Maybe there's, a couple hundred companies, maybe even, up to 1,000 companies that are in that world that don't really have public company requirements or visibility, but there's certainly a lot of, market value there. Maybe, several trillion dollars, perhaps even up to 5 trillion or more. What's your take on that sort of, middle ground world? This is probably where you guys are playing mostly, I think, right?
Well, it's where we begin to play. And I think the
Yeah.
market's
Okay.
going down market. If you look back 10 years ago when the idea of Forge was being developed, there were really only about 5 or 10 companies that traded in the secondary market. Now there's a couple hundred, but there's probably another 1,000 or 2,000 that aren't trading yet. But back in the 2008 timeframe, they would have all been public, given the
Right.
size of their revenues and the size of their valuations.
I think
So
that's
I
what's
think,
weird, right? Is that these companies that would have been public 5, 10 years ago are going to be private for another 5 years, you know?
it's funny. In another venue I was at, someone was asking me about why those CEOs just don't go public. And my answer was, you know how fun it is to run a private company compared to a public company? I can tell you
Yeah.
because I've done both. And
I was going to say, I guess you've had that experience lately.
so as long as you want to be focused on really cool things like building new products and innovating a whole space, being private is great. The second you're public, people want to make sure that your next quarter is predictable, as is your next, 2 years. And so
Right.
anything that sort of deviates from that predictability, long-term investing being one gigantic example, is a detriment to you as an operator. It's very difficult to manage your shareholders if you're
For
having
sure.
quarterly board meet or quarterly earnings meetings and you're not right on plan or beyond plan.
Well, I guess also, it's a combination of the founders wanting to remain private, but also the capital markets giving them the capital to do so.
Correct.
And the canary in the coal mine was perhaps Masayoshi Son and the Vision Fund and somewhat crazy $100 billion fund. I don't know how long ago that was now, probably 7, 8 years ago or something like
Yeah.
that. Even though that didn't necessarily go so well the first time around, it seems like a lot of other people picked up that idea and copied it. We obviously had some ups and downs in 2020 and 21 and into 22, but still seems like there is now a really healthy market for secondary activity. Who are your customers? What are their ticket sizes? What are they buying,
Yeah.
selling these days?
So we're kind of two businesses in one. There's an institutional business here, which trades in $5 to $100 million tickets.
Got
And
it.
then there's a retail and high net worth business that
Yep.
trades in $100,000 to $2 million tickets. Part of the beauty of our platform is it sort of matches these two counterparties, and it creates benefits for retail and institutional. There's a little bit different focus there. If you're looking at the really big institutional investors, they're looking beyond the top 20 names down into who are the
Yeah.
next generation of top 20 companies. And they're trying to get early into those. Retail does what retail does. It understands that Elon and SpaceX is all over the news. AI is all over the news. They don't know all 19 of
Right.
those companies I quote. They know 4 of them, maybe 2. And
Okay.
and they want to go there. So I think it's a matter of who you're talking to, but it's a market that probably in its totality right now trades about 100 to 150 names, but most of the top 20 to 30 are where the retail are focused.
Got it. I guess we've heard from talking to other folks in the past that, the top 5 to 10 names are half the volume, the top 30, 40 names are 80% of the volume. Is that true for you guys as well, or at least the retail part of your
That's pretty close.
business?
That's
Yeah.
It's pretty close. You get a lot of concentration at the top. It's interesting too, because if you watch the public markets, the Mag 7
It's kind of the same
is a
story.
ton of volume. And,
Yeah.
that's one of the reasons why we set out to build some of these fund products, because we thought, man, retail investors should really have some diversification here and not
Yeah.
make just one big bet or 2 big bets. That's part of the reasons why we've been tracking these public funds that hold private shares. And we have one of our own that's in the SEC right now.
Okay. Yeah, I was going to ask you. I know there's been a few folks that have come out in that space, and you probably know a few of them from your earlier days. I guess Destiny and Private Shares are 2 of the players. Robinhood, USVC, and now Power Ben Black also coming out.
Yeah.
You guys have something in the work. I'm not sure I remember the name, but something to do with unicorns.
Yeah, we announced last year that we were putting a 60 name fund out that was
Okay.
not that was an interval fund. It was not a closed-end fund. And it's really
Okay.
important that the world knows the difference, because I'm not sure the world knows the difference. When you're
Probably
looking at
not.
Destiny and Private Shares Fund, both of which were sort of spawned in the predecessor businesses of what is now Forge. These are companies or fund structures that hold a collection of private stock, and these will trade wherever the market wants to take it. So if
Yep.
you've got a lot of speculation, trading those funds is very similar to trading crypto. It's going to run up
Okay.
to 100,000, 120,000. If somebody decides they're going to start selling it, well, it'll drop right back down to $60,000 in a couple days. That's what a closed-end fund does, holding private shares. If you actually took all the private holdings of those funds and you ran them through Forge Price, which is our proprietary pricing and price discovery tool, you'd find that the delta of value in those holdings and what's being purchased in the public market for those stocks don't add up most of the time. There are big
Right.
deltas. So what we did is we decided we were going to put out what we called the Forge Liquidity Megacorn Fund. It's in the SEC now, and it is tracking the daily NAV of the top 60 private companies. And that trades based on the movement of that NAV. And so if you want exposure, it's like buying an index or an ETF fund.
So what does it mean if you're picking up a daily price for these companies that are private? I guess that you guys have some information on what those prices are moving around, but generally VCs, they don't reprice on a daily basis. They
Correct.
barely reprice on an annual basis.
So,
Are you looking at trading activity only on your platform or also on other platforms for those
so
prices?
we're looking at everything.
Okay.
We're looking at all the published funding rounds that VCs do, that a company
Yep.
does. In addition, we're looking at what are people trying to buy it for or sell it for right now. These
Yep.
are IOIs. This is the closest to real-time pricing in the private market. So whoever's platform has the most IOIs, and you can bet that if someone's trying to buy something on Forge or sell something on Forge, they're probably over at the other two competitors trying to do the same. When you're looking
Uh,
at those live IOIs, you can see the bid-ask spread, and then you can start tracking what actually closed. What's a closed price look like? When you've got
okay.
closed prices and those IOIs and funding rounds, and you put it all together, and we've got data scientists here from BlackRock who do this, they'll tell you, here's the closest proximate daily price of pick your favorite unicorn. And when you do that
Okay.
across 60 names and it's weighted by the size of the company, that's the kind of fund that we think, our parents should be investing in if they were going to invest in the
Right.
private markets.